Conclusion. Compared with even a few decades ago, today's investment landscape is fraught with uncertainty and high volatility. Global economies exist in a state of inextricable interconnection, bound to one another by complex supply chains that wrap around international industries, geopolitical tensions that bridge continents, and financial markets that are hyper-reactive and sensitive to change. As investors, the systems we must model are becoming increasingly complex. Financial webs span trillion-dollar industries, and historical datasets reach back decades, if not centuries, offering misleading hope for unparalleled alpha, if only the right strategy can be found. And amid this, we must now prepare for an unprecedented scale of radical uncertainty. Pandemics, financial crashes, cyberattacks, political upheavals, and climate change. And the impacts of these fat-tail events are now larger and more unpredictable than ever. For the unprepared investor, it is a landscape of increasing peril. Yet it is also a landscape of newfound opportunity. With larger data sets, more powerful computers, and smarter algorithms, we can move away from flawed history-based forecasting and now formulate better financial theories. Theories that can predict black swans and intelligently optimize portfolios in real time. The machine learning revolution is unlocking industry-reshaping techniques. Hierarchical risk parity, deep learning regression, k-fold cross-validation, Markowitz's portfolio with purging and embargo methods, and 6 correction to name a few. An investor who can leverage these can capitalize on an economic environment with an untapped capacity of billions of dollars. Having taken this course, you now have all the information you need to build a coherent factor-based strategy and use machine learning techniques to boost system performance. We have explored the zoo of factors, using Birkin and Swedrow's 5 criteria of persistent, pervasive, robust, affordable, and logical to select and test the most valid factors of focus. We have uncovered the factors that investment gurus like Warren Buffett and David Dodd were using long before anyone recognized their genius. And we have covered the evolution of impact investing as it grew from CAPM in the 1960s into a coherent set of stylistic factors that can explain returns across multiple asset classes and economies. In a landscape where marginal gains create exponential growth, by teaching you these traits or factors, this course has given you the building blocks to outperform the market and consistently generate alpha. Along the way, we have also warned of the most common behavioral pitfalls into which an investor can fall: recency, relativism, and impatience. We urge you to remember them. Not only should you now have a greater understanding of how the stock market works, you now know how to conduct research, acquire significant statistical evidence of investment factors, and use machine learning tools. For example, developing on Markowitz's modern portfolio theory, we have learned how the nested clustered optimization technique can enable us to reduce the instability of the results and operate the theory in a real-world financial setting. And using the false strategy theorem and the family-wise error rate, we have learned to evaluate results for overfitting and test the significance of the Sharpe ratio. We also hope, however, that we have instilled in you some more basic but equally important tenets of good investment practice. These simple lessons often go forgotten, but they are the most integral to a strategy's success. They are the discipline to develop and maintain a long-term strategy, and the forethought to diversify your holdings in the face of the world's increasingly volatile and globally interconnected economy. For we believe the best target is sustainable long-term growth, not short-term payouts gained from outmaneuvering the market.